It's 2026 and you've got $10,000 sitting in your bank account. The question is simple. Where do you put it? Stocks? Crypto? Real estate? Each one promises wealth, but each comes with completely different risks, timeframes, and potential returns. Here's the thing. The answer isn't the same for everyone. What works for your friend might be a disaster for you. So today we're breaking down all three options, looking at what 2026 has in store for each, and helping you figure out which investment strategy actually matches your goals, your timeline, and your risk tolerance. Let's dive in. Hey everyone, welcome to the channel where we make investing actually make sense. I'm Alex, and today we are tackling one of the biggest questions in finance. Stocks versus crypto versus real estate in 2026. We're going to look at each investment type through four lenses. The 2026 market outlook, the real pros and cons, the kind of returns you can expect, and most importantly, which type of investor each option is best suited for. By the end of this video, you'll have a clear framework for making your decision. No hype, no BS, just facts. And if you find this helpful, hit that subscribe button and let me know in the comments which investment you're leaning toward. Alright, let's start with the classic. When you buy stocks, you're buying small pieces of ownership in companies. You make money in two ways. Either the stock price goes up and you sell for a profit, or the company pays you dividends, which are basically profit-sharing payments. So what does 2026 look like for the stock market? First, interest rates are stabilizing after years of volatility. The Federal Reserve has signaled they're holding rates steady, which is historically good for stocks, because companies can borrow money more affordably to grow. Second, we're in the middle of an AI boom. Companies investing heavily in artificial intelligence are seeing massive growth. And if you're investing in tech-heavy index funds, you're riding that wave. Third, there's still uncertainty around inflation and global supply chains. If inflation spikes again or there's a recession, stocks could take a hit. But overall, analysts are cautiously optimistic about 2026. The pros of investing in stocks are clear. They're accessible, you can start with very little money, and they're highly liquid, meaning you can sell quickly if you need cash. Historically, stocks have delivered around 10% annual returns over the long term. With index funds and ETFs, you get instant diversification, and dividend-paying stocks can provide passive income. But there are downsides. Stocks are volatile, prices can swing wildly, and they require patience. Panic selling during crashes locks in losses. Taxes can eat into returns, especially if you trade frequently, and trying to time the market usually backfires. In 2026, realistic returns for broad index funds are around 8 to 12% annually. High-growth stocks can do much better in good years, but they can also drop hard in bad ones. Stocks are ideal if you have a long-term mindset. Want steady compounding growth? Don't need immediate access to your money and can handle market ups and downs. Bottom line, stocks are boring to some, but they're one of the most effective wealth builders ever. Now let's talk crypto. Cryptocurrency is digital money built on blockchain technology, a decentralized system that doesn't rely on banks or governments. Bitcoin, Ethereum, and thousands of other coins operate outside traditional finance. 2026 is shaping up to be a pivotal year for crypto. Bitcoin's halving happened in 2024, and historically the years following a halving often see strong price increases. Institutional adoption has also surged, with major companies and even governments holding crypto. Regulation is becoming clearer, with things like Bitcoin ETFs making crypto more accessible to everyday investors. That said, crypto is still extremely volatile. A single tweet or regulatory move can send prices soaring or crashing overnight. The upside of crypto is massive. It offers potentially life-changing returns, true decentralization, 24/7 trading, and exposure to cutting-edge technology like DeFi and smart contracts. It's also incredibly accessible to anyone with an internet connection. But the risks are serious. Prices are extremely volatile. Regulation is still uncertain. Security risks are real, and scams are everywhere. Unlike stocks or real estate, crypto has no intrinsic value beyond what people believe it's worth. In 2026, Bitcoin and Ethereum could gain 30 to 50%, or they could drop 40%. Smaller coins might explode or go to zero. Crypto is for investors with a high risk tolerance who believe in blockchain long term and can afford to lose money. Bottom line, crypto is high risk, high reward, exciting, but definitely not for everyone. Finally, real estate. Real estate investing means buying property to generate income or profit, whether through rentals, flipping, commercial property, or REITs. The real estate market in 2026 is complicated. Mortgage rates are lower than their recent highs, but still elevated compared to the past, which cools demand. At the same time, housing inventory is low, keeping prices relatively strong. Rental demand is high because homeownership is less affordable, which is great for landlords. Real estate's strengths are its tangibility and cash flow. You own a physical asset that can generate monthly income. Leverage allows you to control a large asset with relatively little money down, and tax benefits can significantly boost returns. Real estate also tends to perform well during inflation and gives you a high level of control. But it's not easy. The upfront costs are high. Selling takes time, management can be stressful, markets can crash, and you're tied to specific locations. In 2026, rental properties may deliver 5 to 8% cash-on-cash returns plus appreciation. Flips can earn more but require skill, and REITs offer a hands-off way to earn around 8 to 12% annually. Real estate is best for investors with capital who want steady income, prefer tangible assets, and are willing to be hands-on. It's slow, but it's proven. So how do you choose? Stocks are the most accessible and liquid. Crypto carries the highest risk and potential reward. And real estate offers stability and tax advantages, but requires the most effort. The right choice depends on your goals, your timeline, and your risk tolerance. And yes, you can do all three. A diversified portfolio might hold the majority in stocks for stability, a smaller portion in crypto for growth potential, and some exposure to real estate for income. Diversification helps balance risk and reward. So there you have it. Stocks, crypto, and real estate, broken down for 2026. There's no one-size-fits-all answer. Don't let fear or FOMO drive your decisions. Do your research, start small, and remember, the best time to invest was yesterday. The second best time is today. Let me know in the comments if you're team stocks, team crypto, or team real estate. If this helped you, hit like, subscribe, and turn on notifications so you don't miss future videos on investing and building wealth. Thanks for watching, and I'll see you in the next one.